Welcome back to the Small Business University. In this video, we're going to talk about bookkeeping basics. And several of the videos inside the SBU, the Small Business University, are designed to cover bookkeeping. We want to be able to train you in such a way that you can do most any bookkeeping or financial work that you need to do in your business yourself. So to some degree, this video here is going to start getting into some of the details about financial record keeping. And we're going to be talking about debits and credits. We're going to be talking about ledger accounts. So in order to be a decent bookkeeper for your business, you have to be interested in getting into the details of bookkeeping and learning how to do some of this. If you have absolutely no interest in bookkeeping, do not try and attempt it yourself, and you should probably go out and hire someone to do this work for you. But let me say this, the best business owners that I have ever worked for started out trying to do most of their own bookkeeping, and there's a simple reason for that. Accounting is the language of business, and understanding what was going on in their business was impossible if they did not try and learn how to do some bookkeeping, understand financial reports, and understand how all of this works. So if you're interested in giving yourself the best opportunity for success, I would really encourage you to try and watch these bookkeeping videos and practice and learn this yourself. You will not be sorry if you take the time to do it. All right, let's take a look at the agenda here. So I have 5 different things that I want to go over today. First, we're going to talk about the financial statement and what is in it, what it means. Then we're going to go into double entry accounting. I promise you this is not an accounting level college class. I'm going to try and explain it very simply. You will get it at the end of the video, I think. And then transaction workflows. We'll talk about some banking, and then we're going to do a software overview where I'm going to show you around QuickBooks Online, the software that we recommend and use in our practices each day. I'm going to take you on a little introduction tour because in the next videos, you'll need to know your way around the software to some degree. So to get started with financial statements, what I've got on the screen is the 2 statements that you need to get familiar with. And when we're doing bookkeeping, when we're doing financial statement accounting for our businesses, it is in the pursuit of trying to create these 2 statements. So one is the balance sheet and one is the income statement. Now, first off, the income statement is often called by some others the profit and loss statement. They are one and the same, however, and I will mostly use the word income statement because I think it's more official and it's what most of us accountants say when we mean a profit and loss. But even in the QuickBooks world, they still call that statement a profit and loss. So profit and loss, income statement, same thing. All right, so when we're doing bookkeeping, we're trying to create these 2 statements. Let's go over very generally what is in them. First, in the balance sheet. The first thing to understand about the balance sheet is the balance sheet is taking a snapshot in time. So if it is 10 o'clock on Wednesday, it is like a camera taking a snapshot of your assets, your liabilities, and your equity. And what it's saying is, in that moment, this is what you owned asset-wise, what you owed in liabilities, and what your equity was in your business. Now, the first calculation to kind of understand about the balance sheet is it's assets minus liabilities equals equity. So if you think about that, if you had assets of $100 and you had debts or liabilities of $50, 100 minus 50 equals $50. That's the equity you have in your business. Because if you were to liquidate your business today, you would need to pay off your debts. You would have to spend $50 of your cash to do that, and you'd be left with $50. So assets minus liabilities equals equity. Now, up at the top of a balance sheet are the assets. And you'll have things like current assets, investments, property, plant, and equipment. Don't get too worried about these quite yet. We'll dive into these in the deeper dives into bookkeeping. But just know that these are usually things that are of some value and are kind of good guys. Assets are good to own in general, right? You want assets. So I try and think of assets as, these are the things I'm glad I have. Liabilities, on the other hand, are generally things where we owe something to someone or some other group. And I try and think of liabilities as, they're not bad. Sometimes you need to take on loans to grow your business, right? But they aren't necessarily something you want around. They're kind of this thing of, yes, I'll have it, but I don't want it. So in many ways, very healthy businesses, in a very simplistic way, would only have assets. They'd have no liabilities, and thus all their assets would also be equity, right? Because if you had $100 in assets and zero liabilities, you'd have $100 in equity. Stockholders' equity is often kind of confused with what your business is worth. Don't think of it like that. Keep that in a different kind of conversation. We'll talk about that in the Small Business University, but don't really think that's what your business is worth. Your business is worth usually a multiple of what it makes or what it has. But equity is really the place where we're saying, this is what we have accumulated. So think of it that way. This is what we own outright and have accumulated for ourselves and our owners. So going back to the beginning here, assets, good guys, liabilities, not good guys, and then equity is what we have accumulated for ourselves. Thus, it is assets minus liabilities equals my equity. Now, the other statement is the income statement. And this is one that most even new business owners and most business owners probably pay attention to the most, because this is kind of like a scorecard of how your business is doing, whereas the balance sheet is a snapshot of things that you own or owe. This is about how much you're making, how much you're spending, and what your net income is at any given time. As opposed to the balance sheet, which was a snapshot in time, the income statement is run for a length of time. So you may run it for Monday through Friday. You may run it for January through June. And most often you'll run it for January through December. So you can see its time frames. It's not a snapshot in time. And each time you run this, you're going to have some very common elements. The first is going to be revenues. Revenues are another way of saying money you have earned, income. I don't like to say income very much. In accounting, we typically say revenues a lot more, because income is a word that a lot of times we name these different accounts. So when we're trying to talk about all of them together, we'll say something like revenues. So at the top of every income statement is a aggregation or a totaling of all the revenues that you've earned for that time period. So if you're running an income statement for January, your revenues are going to be different than if you're running an income statement for January and February, because that income statement captures both months, whereas the one run for January just captures one. The same is true for expenses. Now, just like revenues, expenses are the money that is going out. It's going out the door. So revenues in, expenses, money going out. And what we're trying to figure out in an income statement is revenue minus expenses equals net income. Okay? Now, something I try and point out as quickly as I can is notice how revenues are all positive numbers, and also how expenses are all positive numbers. Don't ever think that an income statement is supposed to be positive here because this is income, and then a bunch of negative numbers down here. That's actually not how it works, because the net income is trying to subtract a positive number and a positive number. So if you ever see on your income statement any kind of negative values, that should be a quick indicator that something may be wrong. The same is true over on the balance sheet. All assets, liabilities, and stockholders' equity generally are positive. And if you see things that are negative on your balance sheet, although there's a couple of things that can normally be negative on a balance sheet, and we'll get into that, but for the most part, everything's supposed to be positive here. If there's one thing you leave with in this video today, it should be, if I see negative amounts on my financial statements at any point, I should ask myself, is something wrong? And that will save you quite a bit of headache in your life, because trust me, it is a very quick thing that us accountants do as well to try and figure out if things are going right. Now, let's talk a little bit about double entry accounting. And what I'm going to do here in a moment is bring in real copies of a profit and loss and a balance sheet. But before I do that, I want to kind of just touch on this idea of what is double entry accounting. So double entry accounting was invented hundreds of years ago, and basically what it says is for every transaction, two things happen. And those two things are called a debit and a credit. Now, in your life, you have heard these terms before, and they mean things to you. Usually a credit means that you got a credit on a statement, or you increased value in some way. It's a credit. I'm glad I got that credit. Even on a tax return, when you get a credit on a tax return, right, that's good. It helps to offset the tax that you owe, right? And a debit, by the same token, you may believe is a bad thing. A debit is where they're subtracting money away from you, that kind of thing. I get it. But for accounting purposes, do not think that way when we're talking about double entry accounting. Because really, and this is what one of my professors once taught me, debit just means left side, and credit just means right side. And what he really means to say is, and what to get down to the essence of that, debit and credit are just ways to say there are two transactions or two entries in every transaction. And so debit in the accounting world can mean increase or decrease, and credit can mean increase or decrease. So whenever we start talking about these things, just know that you got to lose the connotations and say debits and credits can be anything. Really what matters is that they are the separation of entries in a transaction. Here in a moment, I'm going to show you a example transaction where a company makes a bank deposit and what happens, and when they write a check, what happens. DR stands for debit. CR stands for credit. So in a bank deposit, and we're going to get into this here in a second, cash is debited for $100 and revenue is credited for $100. In fact, however, this is a great explanation. This means your cash went up. It was a debit and your cash went up. And on your credit side, your revenue went up. And we're going to get into some of that. When a check is written, on the debit side, your expenses really did go down. And on the credit side, your cash really did go down. So here is an example where both things went down. Both things went up here. Both things went down here. So see, debit and credit has nothing to do with what you believe they are. They're just a separation of entries. Now, before we get into explaining this a little bit more, let me pull over a PDF that I've got that shows a little bit more about, and I'll shrink this down a little bit more about what a profit and loss and balance sheet looks like in a little more complex form. So this is the profit and loss, i.e. the income statement. And you can see that it says October 2016. What that means is that this income statement is for October 1st through October 31st, 2016. And you can see at the top, it's got several income items. Income, all of these things. Now look right here, pest control services negative 30. And that's in income. That could be a problem, couldn't it? Same up here, this is discounts given, so this actually is probably okay because it's a discount to this amount. But right down here, pest control services being negative 30 in the income item, you might want to look at that, because what that really means is that in pest control services, more money went out than came in. And it may be that it needs to be down here in expenses. But as you can see, we add all of these things up to get total income right here. And then we start the expenses. The first expense we see is cost of goods sold, which is a way of expensing things that we may maintain in inventory. And then we have a whole bunch of other expenses, advertising, equipment, all of this. And as we scroll down through all these expenses, noticing that they're all positive too, we come down to net operating income. And this is what the revenue minus the expenses in total equal. And this means this is what you made. This was your profit for the month. Now, it looks like there's another miscellaneous expense here that was not up here that now has got the income all the way down to $163 loss. That negative right there means you actually lost money. You had more expenses than you had in income. But it illustrates how this report works. Let's take a look at the balance sheet. I'll shrink this down just a little bit too. And the balance sheet at the top says balance sheet as of October 31st, 2016. So what's this saying? This isn't for October 1st through October 31st. Remember, a balance sheet is a snapshot. And so this is a snapshot just on this day, October 31st, 2016. And on that day, we had total assets of $24,336. And you can see some of them are bank accounts. Some of it is that people owe us money. Some of it is inventory and undeposited funds that we've received from customers, but we haven't taken to the bank yet. And then this is a truck. So these are all assets. Now, if I scroll down, these are all things that we owe. This is accounts payable, the bills that we have. This is our MasterCard balance right now. These are payroll and loans that we have to pay out to different boards of tax due and a loan payable. And then this is a big note payable of $25,000. So these are all liabilities right here. We have $31,000 worth of liabilities. Well, wait a minute, Chris. If we've got $31,000 worth of liabilities, but only $24,000 of assets, don't we owe more than we have? You're absolutely right. Look here. The equity is negative. The equity is negative $7,641. When your liabilities exceed your assets, you have negative equity. That means you owe more in your business than you have. Now, one thing to notice, see how total assets right here is $24,336? And total liabilities and equities $24,336? Those always will match. So total assets will always match total liabilities plus equity. And the other equation that we use for the balance sheet is assets minus liabilities equal equity. So that's why these two things always balance out. So that's kind of what a real financial statement looks like. And if we were trying to figure out if this looks good, look, there's mostly positive numbers here. Positive, 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 except for the equity section. And the equity section can be negative if liabilities exceed assets. But for the most part, everything else, at least on the first review, may be pretty good. Now, let me move this back out of the way, and we will move on to the next slide here. So in double entry accounting, the first example I want to kind of talk about is this depositing $100 to the bank, this first example. And what's happening is, this is going to illustrate double entry accounting because there's two things happening, even though it seems like maybe just one transaction. That is, you're just taking $100 to the bank. Well, on the balance sheet, okay, this is where your checking account lives. And when you took that $100 to the bank, what happened on the balance sheet? That's right, cash went up by $100. So just like when you think of your checkbook on the balance sheet, when you take a deposit to the bank, your cash went up $100. So that's one entry of double entry accounting. At the same time, this $100 that you got was from a customer. Okay? They paid you $100 for a service that you provided. So there's an entry on the income statement on revenue. That went up $100 because your income statement needs to reflect that you've earned $100 at this point. So in very simple terms, your revenue went up $100 and the check you received was for the work you did. Is this starting to make sense? See how there's two things always happen. Balance sheet account went up, income statement account went up. Now, there can be times where an income statement account went up and an income statement account went down. Those are the two entries. Or there can be times when a balance sheet account went down and another balance sheet account went down. That can happen. And I'll show you some of those here in a little bit. But no matter what, there are two things that happen. Doesn't mean they have to be one on each, is my point. Doesn't have to be one on balance sheet and one on income statement. It can be both of them here, or one here and one here, as this transaction was. All right. Now let's look at another one. This is now I am cutting a check to pay my electric bill, okay? And in this case, right, on just the opposite of what happened with revenue, on the balance sheet, whenever I sent that check out the door and essentially it got cashed, $50 went out of my account. So my balance sheet account went down now. My balance sheet account went down by $50 of this check. Also, on the income statement, I need to record the expense. And the expense went up $50. Now, here's where people sometimes get confused, and that's why I emphasize on the income statement there's never a negative number. Because you may be looking at this going, well, this went down 50. Why didn't this go down 50? Well, because when we're increasing expenses, it's a positive thing. We're increasing the expense. Now, later, the income statement's going to subtract this from revenue. But never put a negative amount in an expense account. It's always positive. But it's still the same transaction. You increase your expenses, thus you spent money. And so on the income statement, you're showing an expense and your cash went down. Let's take a look at it in the aggregate now. So on the balance sheet, as a summary of both transactions, on the balance sheet, in our cash account, we increased it by $100, but we also decreased it by $50 when we paid that out. So the ending balance in our balance sheet is $50. The income statement had something similar go on. We booked revenue for $100. We had the electric expense go up by $50, and that means our profit is just $50. This transaction and this transaction are double entry accounting, and then this entry and this entry is double entry accounting. So you had two transactions, each with two entries, and they affected both the balance sheet and the income statement. So that is a very high-level look at double entry accounting. As we go through bookkeeping, we're not going to stay in this double entry accounting mode of things. We're going to get into the actually what you would do in the software when you're doing each of these. But getting some kind of basis of what all of this is doing in the background is always a good idea. So let's move on now, and we'll jump into some more topics here. The transaction workflows is really what we're going to talk about from almost here on out, because understanding all the different kinds of transactions and things that can go on in your business and what to do inside your bookkeeping software is the best training you can have when it comes to accounting. In this video, I'm going to show you a few different workflows, namely receiving money, paying expenses. These are similar to what we just went over in the simplified examples. And then withdrawing profits from your business. So let's say you made some money, it's the end of the month, and now you want to pull those profits and give them to the owners. I'm going to show you how to do that. Later in the future videos, we're going to go over more complex things, such as purchasing inventory and such as paying employees. We will get into how to do checks that have bounced. We'll get into how to do larger transactions with multiple accounts going on. So we're going to show you how to do everything I think that you would need to do for your business. But let me show you these three here real quick. So first off is going to be money from a customer. And I've got kind of a workflow here. You can see how we start here, right? And we kind of work our way to the right and then down and then work our way back over to the left. And I'll kind of explain, this is just high level, but kind of an idea of what's really happening in our bookkeeping software. So when we have a customer that we've done work for, okay, and we're about to kick off the customer needs to pay us process, the first thing we're going to do is we're going to create an invoice or a sales receipt. We'll define what some of these are in future videos, but we're going to create an invoice or a sales receipt in our software, and we send that to the customer. The customer then is going to pay us either by a check, credit card, or cash, right? That payment is then matched to this invoice, to where now that invoice or sales receipt no longer shows as outstanding. It shows that it has been paid, and basically almost you can think of it like it cancels itself out. When the payment is matched to the invoice or sales receipt, the check or the cash then goes to the bank, right? And the credit card deposit will go to your bank in like 3 days. So while checks and cash go to the bank today, right, because you drive it there, the credit card deposit, you don't get anything. You just get kind of a receipt that it's happened. And then 2 or 3 days later, that cash will fall into your bank account. What is then happening is revenue and cash, right? Revenue on the income statement and cash on the balance sheet, both of those accounts increase. Boop, boop. Just like we had in our previous example. And then the receipt is provided and the transaction is complete. Now, as you know, or maybe have instincts of, there's other things that are going on there, but this is the essence of it. This is the essence of it. And getting that foundation right is critical to knowing what to do inside the bookkeeping software later as we're going through specific examples and how to do things. Let's take a look at an expense type of item, and this is paying vendors. So the process is very similar. It's money going out the door rather than coming in the door, but this is one of the things you'll notice about accounting. Once you get the hang of it, things are very similar regardless of which direction money is flowing. So in this case, the vendor sends us a bill, and we enter it into our bookkeeping software that we owe this person. Kind of like when we entered an invoice that someone owed us. In this case, we're entering a bill to say we owe someone. We then pay the vendor with a check, a credit card, or cash. The payment, just like when we were talking about an invoice, the payment is matched to the bill, meaning that, okay, now this bill is no longer outstanding. The check or the cash, if you paid the vendor via check or cash, that cash leaves the bank, doesn't it? So now when he cashes the check or gets your cash, it has left the bank, and a credit card, if you pay by credit card, shows as a charge on your credit card bill. What happens then is expenses on your income statement increase because we just paid somebody, so expenses increase, and the cash that you paid them with decreases on the balance sheet. Little weird thing is if you have a credit card, your cash may not decrease. In fact, your liabilities go up because you have a loan essentially now, right? So that's a liability, not an asset. But in either case, the balance sheet accounts are affected depending on whether you use cash or check versus credit card. But they're both very simple, and we'll show you how to do all of that. Finally, after all of that has happened, the verification of the payment transaction, or the verification of payment is sent to you, i.e. like a receipt from the vendor, and then the transaction's complete again. So these are very similar, right? I mean, if you're looking at money from customer versus paying vendors, it's very similar type of transaction. And that's why it's going to be so easy for you to get the hang of doing your own bookkeeping. Because trust me, once you start to see all this, you say, oh, this is pretty simple. Now, the last one I want to show you is how do you withdraw profits. And this is really easy. So let's say that you've operated for the month and it's the end of the month and you've made $5,000 profit. So you could think of your revenue as maybe 10 grand, 10,000, and your expenses were 5,000. And so you made 5,000, right? 10,000 minus 5,000 in expenses equals 5,000 profit. Well, if the income statement shows profit, you can then, via check or cash, just transfer that money out. So you literally go into the corporate checking account and you transfer $5,000 from the corporate checking account to your personal account. And what happens is the cash on the balance sheet goes down, right? Because you transferred 5,000 away from it. But here's an example of where both entries are on the balance sheet, because this is not an expense. When you withdraw profits, and this is kind of the point of this slide, when you withdraw profits, it is not an expense like you paid your utility bill. This is an equity transaction, meaning whenever you earn that $5,000 profit, usually on the balance sheet, right? Remember the balance sheet right here. On your balance sheet under equity, you would have 5,000 because that's what you made. You earned cash and you made $5,000. Well, when you pull that out, your equity account goes down by $5,000. So your cash account went down, which was an asset, and your equity account went down, which was part of the liabilities and equity section of your balance sheet. So that is a transaction where it just hits the balance sheet. Never, ever, 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 ever. I'm being very literal, right? Make distributions to yourself where you are taking profits out of the business or a loan or anything else. Never let that hit the income statement, because that is not an actual expense. Your expenses are the things you pay other people who are not owners. Sometimes you may pay yourself payroll, and that would be an expense, but only if you're running it through a payroll system and paying withholding tax on it and everything else. Otherwise, if you're just moving money out of your bank account to yourself, 99 times out of 100, that is an equity transaction, just like I'm showing you here. So those are a few workflows. We're going to get into the nitty gritty with it in Bookkeeping Deep Dive 1 and Bookkeeping Deep Dive 2, which are later videos here in the series. So let's move on to the next slide here. Yes, banking. So banking is one of these things where you have to understand a little bit, and I'm just going to kind of drop an idea on you, and I'm going to show you something in QuickBooks Online here in just a second. But something to understand. If you've got a bookkeeping piece of software, which is like QuickBooks, it's the QuickBooks logo, and every day, every morning usually, QuickBooks will go and log into your bank account, in this example Wells Fargo, and read the transactions and bring them over. Okay? Now, one of the things to realize about that interface is that it is always only pulling yesterday's transactions. It has no idea what is going on today. So every time your software syncs, just always remember that this is pulling the past, yesterday. And so if you're entering transactions in QuickBooks today, the system may be a little bit different than what you see in your bank account, because in your bank account, it only knows what happened yesterday and prior. So this is a concept we'll go into whenever we show you how banking works, but I want to pull over QuickBooks Online real quick. And QuickBooks Online has this sample company that we're going to play around with most of the time. This is QuickBooks Online, and these are my bank accounts over here. And I'm going to click into the checking account right here. And what's going to pull up is it's going to pull up all these transactions that it has seen from yesterday or something like that. And what it's looking like is we had a lot of different transactions, and some of it was already in our bookkeeping system. And see how it says match? That's because it says, hey, I pulled this transaction from Wells Fargo, but it matches a transaction that you had already entered in here. So I think we just want to match it. We don't want to add it and double it, count it, because this is already in here, and we just didn't know that it was in here until we saw the transaction come through later on. However, there's also transactions here where you can add transactions. And this is basically saying, if you want me to add this, I have no idea. There's no transactions that match this, at least that I can find if you're QuickBooks. And do you just want to add this transaction? And so this concept of it's downloading yesterday's transactions is going to be important when I start teaching you how to use this screen. Because you have to always remember, hey, it doesn't know what happened today. All it knows is what happened yesterday. So that's a little introduction. Don't worry. We're going to get into every facet of this and how this works and how to set it up and what to do. But I just wanted to drop a little bit of a hint on how some of this banking works and emphasize that it only has yesterday's information in it. Finally, that's really the end of what I wanted to chat about today. We're at about 33 minutes, so that's the kind of length that I wanted to have too. But do this for me. If anything didn't make sense to you as you watch this video, just go back and watch it one more time. One of the best ways to gain knowledge in accounting, because a lot of it can seem confusing on first pass, just go back and watch it again and maybe 3 times. If after 3 times you're still not understanding it, reach out to us at SBU and we'll help guide you through any kind of questions that you've got. But it is the rewatching of accounting concepts and what we're doing that will make all of this sink in. And what you're waiting for is kind of this aha moment where you go, oh, I see what you're talking about. I get it. And the more you watch it over and over again, eventually you'll have that aha moment. Every accountant does, and you will too. So from all of us here at SBU, thanks for watching. The next videos are Bookkeeping Deep Dive 1 and Bookkeeping Deep Dive 2. If you want to, you can skip forward to those now because you are ready to watch those now that you've watched the intro here. So I will see you in those videos. All the best.